You've been watching a market fall for weeks, red candle after red candle. Everyone around you is bearish. The news is terrible. And somewhere in the back of your mind, a question forms. Is this the bottom? Most traders answer that question wrong, not because they lack intelligence, because they're looking for the wrong thing. They're looking for a single signal. One candle, one indicator, one moment that says, this is it. But market bottoms don't work that way. A real bottom is not a signal. It is a sequence, a chain of specific events that stack up one after another until the picture becomes undeniable. And in this video, I am going to walk you through every link in that chain so that the next time you see a potential bottom forming, you are not guessing. You are reading evidence. Not financial advice, just education. Let's get into it. Before we go through the sequence, I want you to hold one idea. The best bottoms, the ones that lead to sustained multi-week or multi-month rallies, almost always follow a recognizable path. Different frameworks describe it differently. Wyckoff calls it accumulation. Smart money concepts call it a liquidity sweep followed by a market structure shift. Price action traders call it a base and break. But beneath all those labels, the same mechanical sequence is happening every single time. Selling exhausts itself, the market retests, a trap forms, structure shifts, and only then does the real move begin. Remember that sequence: exhaustion, retest, trap, shift, entry. That is the chain. Break any link and the setup falls apart. Now let's build it step by step. Step 1. Selling exhaustion. The market stops falling not because buyers arrive, but because sellers run out. This is where most traders completely misread what's happening. They see heavy selling, massive volume, red candles everywhere, and they assume the selling is going to continue because the momentum is so strong. But here's what's actually occurring beneath the surface. At some point during a prolonged decline, something subtle changes. The selling is still heavy, volume is still enormous, but price stops making meaningful new lows. It's like throwing punches at a wall. The punches are landing with full force, but the wall isn't moving anymore. That is absorption. Someone is on the other side of every panic sell, quietly buying everything being thrown at the market. Not aggressively, not in a way that pushes price up. Gradually, absorbing the flow without disturbing it. And this makes complete sense when you think about who is doing the buying. Large players, institutions, funds, they cannot build positions in quiet markets. If they buy aggressively when volume is thin, they push price against themselves before they can finish accumulating. But during panic creates exactly the deep, liquid selling environment they need. High volume, motivated sellers, predictable order flow. The conditions that allow size to get filled without moving price. So every time you see heavy selling with no downward price progress, that is not weakness. That is informed money using the panic to build positions at prices they want. Then something natural follows. With sellers spent, price bounces. Not because buyers suddenly appear in force, but because there is simply nobody left selling, like lifting your hand off a ball submerged underwater. It floats up because the force holding it down is gone. This bounce is important, but it does not confirm anything yet. What comes next is what actually matters. Step 2. The retest. And why this is the step most traders misread completely. After that initial bounce, the market comes back. Price retraces toward the lows. And this is where most traders make their first critical mistake. They see price returning to the lows and think the bottom has failed. The selling is resuming. They exit prematurely or never entered at all. But this retest is not evidence the bottom has failed. It is the market asking a question. Can the sellers push it back down again? The answer depends entirely on what the volume looks like on the retest. If price returns to the same area that saw enormous volume during the panic, but this time the volume is noticeably lower, smaller candles, less conviction, quieter movement, that contrast is your first real confirmation. The sellers tried again. Almost nobody showed up. The panic volume was not distributed selling, it was absorption. The buyers who stepped in during the panic are still holding. The bottom is holding on much less effort than the original move down required. That is the retest passing. That is link 2 in the chain confirmed. After this, the market typically drifts sideways for a period. Volume contracts, range tightens. This phase looks boring and unremarkable from the outside, but something important is happening. The absorbing side is continuing to accumulate gradually, trade by trade, without pushing price up against themselves. This takes time, and many traders mistake the small bounces within this sideways phase for the actual bottom, enter too early, and get caught when price dips again before the real move begins. Patience through this phase is not passive. It is the discipline that separates the traders who catch the real move from those who get shaken out before it. Step 3. The trap. The most important event in the entire sequence. After the market has built its base, the absorption zone, the sideways drift, one event tends to resolve everything. Price breaks below the established floor. It looks exactly like a breakdown. It feels like the downtrend is resuming. Latecomers who were already bearish add to short positions. Stop losses below the range trigger for everyone who bought the range. Panic increases, and then the market reverses sharply, snapping back inside the range and leaving everyone who sold the breakdown trapped on the wrong side. This is the trap. And it is the most important event in the bottoming process because of what it does mechanically. When price breaks below that floor, stop losses trigger. Stop losses become market sell orders the moment they're hit. A wave of mechanical selling hits the market all at once. But here's the critical distinction. That selling is not conviction-driven. It is mechanical, stops firing automatically. Once those stops are cleared, the selling stops completely. And the traders who got stopped out frequently re-enter shortly after. Short sellers begin covering. All of this creates the reversal fuel that sends price back up sharply after the trap. Here's how to distinguish a high-quality trap from a dangerous breakdown. It comes down to the volume on the break. A trap on low volume is the cleanest signal. It tells you the sellers are essentially gone. There was almost no supply left to fuel a real breakdown. The break was mechanical, stop triggered, and the reversal is highly probable. A trap on moderate volume still works but demands more patience. Wait for a quiet retest of the broken level afterward before committing. A trap on heavy volume, wide red candles, aggressive participation, requires the most caution. Supply is still present. Wait for a full retest on low volume before considering an entry. The quality of the trap tells you exactly how much patience the subsequent entry requires. Low volume trap means you can act quickly on the reclaim. High volume trap means you wait for additional confirmation before entering. Step 4. The structural shift. Proof that what you saw was real. The trap happened. Price snapped back inside the range. But how do you know the reversal is genuine and not just another bounce before a continuation lower? You need proof, and that proof comes from one specific event. Price breaks above the most recent significant lower high. The last pivot where sellers had control, and it does so with displacement. Not a slow grind above that level, not a series of small, indecisive candles. A strong, impulsive, full-bodied move that pushes decisively through that level and does not immediately pull back. That is the structural shift. That single event tells you the character of the market has changed. From bearish to bullish. From lower highs and lower lows to the first higher high since the decline began. Why does displacement matter so much? Because displacement is evidence that supply at that level has been genuinely overcome. A slow grind above a level can still fail. Supply can still overwhelm buyers on a gradual push. But a fast, impulsive, high-momentum break through a level means buyers stepped in with real size and real conviction. The sellers at that level could not hold it, and very often that impulsive move leaves behind a fair value gap, a zone where price moved so quickly it skipped through levels without trading there. That gap becomes relevant for your entry because price frequently returns to fill it before continuing. Step 5. The entry, where everything comes together. After the structural shift, don't chase. The most common mistake at this stage is entering immediately after the displacement candle because the excitement of finally seeing confirmation makes traders impatient. But after a strong impulsive move, price often retraces, and that retrace is your actual entry opportunity. If it doesn't retrace, that is a trade you skip. Better to miss one than to chase and take a poor entry after a long sequence of patience. You are looking for price to pull back into one of two zones. The order block, which is the consolidation zone right before the impulsive displacement move launched. This is where the buying pressure originated, and it frequently acts as support when price returns. Or the fair value gap, the imbalance left behind when the displacement moved so fast it skipped through levels. Price tends to return to close that gap before continuing. For a valid entry, three things need to be present. Confirmation, which means the trap happened and structure shifted. Location, which means price has retraced into the order block or fair value gap. And a trigger, which means within that zone you see a clear rejection candle, an engulfing candle closing back above the zone midpoint, or a hammer showing strong rejection of lower prices. All three present and you have a genuinely engineered entry. Not a guess, a setup where the chain of evidence from exhaustion all the way through to your trigger is complete. Your stop goes below the zone or below the trap low for a wider approach. Your target is the first significant supply zone or resistance level above. Volume connects every single step. Throughout this entire sequence, volume is the thread that either confirms or invalidates each link. The initial panic had massive volume. That is your reference. The retest should have significantly less volume. Less effort to reach the same area means the sellers are losing conviction. The sideways drift should have contracting volume, supply being gradually removed. The trap tells you the most with its volume. Low volume on the break means sellers are gone. The structural shift should have expanding volume on the displacement, real participants entering with size. And once the advance begins, you want to see volume expanding on the up moves and contracting on the pullbacks. That is demand in control. That is the pattern of a genuine new trend beginning, when the chain breaks, not every sequence completes. Sometimes the trap doesn't reclaim quickly. If price breaks below the floor and stays there, doesn't snap back into the range within 1 to 3 candles, that is not a trap. That is a real breakdown. The stop cascade became a genuine continuation move. Exit. The setup is invalid. Sometimes the entry zone doesn't hold. Price retraces into the order block or fair value gap and slices right through both. When this happens, what was support becomes resistance, and the premise is wrong. Accept it early and move on. The chain of evidence only works when every link holds. When one breaks, the trade is over. Here is the mindset shift that makes all of this actually usable in real time. Stop looking for a single candle that tells you the bottom is in. Start building the chain. Ask yourself where exhaustion occurred. Did the retest pass on lower volume? Did a trap form and reclaim quickly? Did structure shift with displacement? Is the entry zone holding with a trigger present? When you ask those questions in sequence, you stop feeling the emotional pull of trying to call a bottom. You start reading a checklist, and a checklist does not get emotional. It simply tells you whether the evidence is there or whether it isn't. Drop a comment. What stage of this sequence do you find hardest to read in real time? The retest, the trap, or the structural shift? I read every single one. I'll see you in the next video. Stay disciplined.